Maija was one of the original team helping create FT.com and later helped set up the FT's social media team. Erin Hallock is also joining this fireside chat, managing partner at BP Ventures, responsible for the origination, appraisal, completion, and management of a portfolio of investments across the innovation and engineering sector. She has been advising businesses for over 18 years, initially as a management consultant, but more recently as an investor, where she's led over 15 investments in UK-based early-stage and mid-market companies. Please, welcome.
Okay, thanks very much, Nicola, for the introduction. And I know we're the last session before lunch, so I'm really, really grateful to everybody who stayed to listen. But it's going to be worth your while because I think this is, I'm hoping this is going to be a super sort of practical roll up our sleeves to find out a little bit about the nitty-gritty session. So, and just to say hello to everyone, I am the new editor at GCB. Don't worry, Jim is still here, but I'm taking some of the editing burden off Jim. And welcome, Erin, and thank you for taking time to talk to us about this. And just to kind of set the scene, you know, Saul Klein this morning set this kind of big clarion call to corporates saying that, you know, this was the remaining thing to kind of unlock, to kind of really bring Europe up to the point of being able to really make significant investments and significant leaps in these really hard to solve problems, right? So the big problems, the things that are going to need a deep tech solution. And corporates are well equipped to do that in theory, but in practice, they're not doing it nearly as much as they should. And I think you're going to help explain a little bit why. So, because I think, you know, you were telling me earlier about BP and the way that you're looking at sort of some of the sustainability investments. So tell me about where the kind of the frictions are coming in some of those.
Yeah, so I guess Maija and I were speaking yesterday to kind of brainstorm ideas for today's conversation. And there's, you know, we've been grappling a little bit like, and I think other CVCs do this, and particularly CVCs that are probably earlier in their journey, is I've got to build a track record. So I have to land some quick wins. So I'll make a safe bet. And maybe it's investing in the Series C or kind of late stage growth, and the economics aren't probably going to be as compelling, but I know that I'm going to get that outsized return, and I can prove my worth, and hopefully therefore my, you know, that sustainability, but in a different context, but that I've got some longevity here. I think the other thing too that some struggle with as well is this a fleeting hobby for whoever the direct report is? And if he or she leaves, again, will I have longevity? So I've got to curry favor upwards to whomever that individual is. And so I'm not prepared to necessarily stick my neck on the line or do those things that I think are really compelling and really interesting, the things I ought to be doing, the things that, you know, you do the job, quite frankly. And I think the other is this is a recent investment that I'm really struggling with to try to raise the syndicate. And I've been struggling with this dilemma of, do I play the role of the investment banker and try to actually pull the round together? Because I think if this business takes off, it fundamentally changes not just BP's ability, but all of the people within kind of the ecosystem of this particular technology. It changes their ability to reduce carbon emissions. And so it's in the sustainable aviation space. And my view is, and this is my view rather than BP's view, we absolutely have to be looking at this. Aviation is a hard to abate sector, and it doesn't have a credible decarbonization plan. So we have a unique role that we can play to help aviation in that. But this technology costs hundreds of millions to build a demonstration unit. And everyone who's looking at it is saying, well, I can't exit in 5 years. I can't exit in 7 years. I need a 25% risk-weighted IRR, and therefore I can't get this across the line. And so my question is, you know, so the other kind of probably the third challenge in kind of doing some of these step-out transformational investments is also kind of we're a slave to IRR, or we're a slave to kind of presenting a 5 to 7 year exit with our IC. And if we are braver and say, I'm going to kind of park the IRR conversation because in 20 years, this has a potential to be a unicorn. Let's look at it on that basis. But that's a really hard conversation to say with organizations. And I think particularly with a lot of corporates that are often, overanalyze things. It's the analysis by paralysis. It's a lot of consensus-driven conversations, and they're not comfortable with the risk proposition that VCs operate in. Like, I'm really comfortable with failure, but I can tell you BP is not.
Yeah, so it's that kind of dilemma. So, and just to kind of to set the scene, we're not going to, mention the company, but just that it's a company that from a very early stage BP has had a relationship with. They're now at the point where they want to raise a Series A, right? So this would be the point at which they can start to build out. And yeah, as you say, demonstration unit, really put the proposition together. But this is becoming the sticking point where it's hard to raise a syndicate. And presumably you've gone to all sorts of parties, right? So what do the conventional VCs say? They don't want to touch it because it's too far out. It's too long for them to get that return.
So yeah, and it kind of a little bit more context. The company, they've raised seed from friends and family and ultra high net worths, and then two smaller CVC. Well, one smaller CVC and the other is a family business, and they've raised the capital from the family office. So they've raised a fair bit of capital to get to this point. And the issue as well is the Series A is outsized. Like, most of us are used to Series A, which is probably on the order of 10 to 20 million. This is effectively 10 times that. So that's one of the issues, but they've approached a host of infrastructure investors and financial VCs, and the feedback has been the IRR point that I raised, the exit horizon. They need a kind of 5 to 7 year, and then a number of them have also said they're focused on deployment risk rather than kind of execution risk. And because this is building a first of a kind demonstration unit, it doesn't fit that thesis.
Yeah. And so then that comes into what we were also talking about yesterday. So the financial VC model just doesn't fit this kind of investment. CVC could fit this, but you're also getting pushback from the CVCs as well, or what are their concerns? Because are some of them coming in on this, but others are, again, they see it just as too risky?
So some are saying it's a bit risky. They're prepared to do a smaller check. But that doesn't, I don't know, it's like trying to rob Peter to pay Paul. It's like you can cobble together a lot of £2 million investments, but it's going to take them a long time. And that adds complication to the cap table when they've already raised from a number of high net worths, so they've already got a long list on there. It just adds unnecessary complication. And then a number of them are saying exactly what I said. For that level of risk, I probably need I need an outsized return in 5 to 7 years, and I don't think this delivers it.
And again, so the reason, and that almost to me seems like very similar to the way that the financial VCs are approaching it. So this comes back to the problem of our CVCs they're trying to measure themselves against a financial VC type of criterion, that they want to have those returns in that same kind of time scale. That's the expectation. And actually to solve this problem would be to change the expectation, change the time frames, change the IRR conversation, as you said. I mean, what would be your recommendation for the CVCs that you'd hope to work with? How could they break through that bottleneck right now?
I mean, I guess what I've done what I think is important is I think it's almost stepping back a little bit, and it's selling the possibility and this is a very unique, but I think it's saying that and I guess let me back up, I'll kind of generalize it more. I think as CVCs, we don't have to operate from those same constraints. Those are often sort of self-imposed constraints that we're saying we have to demonstrate this, but because effectively we've got two variables in our formula, we're looking at financial return and strategic return. And that's an advantage, and I think we need to use that more when we're pitching some things that are a little bit left field, but they're fundamentally have the potential to transform the industries that we operate in. So I think you need to focus on that second value of, or second variable of strategic value. I think the other thing too, and this isn't to say it's about greenwashing, but I think it's about selling. It's a marketing pitch for your own investment. So this has the ability to fundamentally transform our business. We could build $1 billion business in a very hard to abate sector. We absolutely should be doing this. And if it's going to take a decade or two to get there, that's still the right thing to do. If I back up, and this is specific to this particular case, it took hundreds of billions to build the refining infrastructure and decades. So we have to look at it on that same principle. So it's a little bit of, I think, and we all do this to some extent when we go to IC. Your pitch, it's a bit of a marketing pitch, and then you drill into the numbers. But I think we do with some of these have to focus on the narrative and why, despite some of the numbers, you still think it's worthwhile. And I think it's focusing on the narrative. And then I think in some cases it's maybe parking the IRR conversation for a bit, and maybe it's the money multiple.
And that can convince them, because the other side of it is that short-termism that can be inherent in a lot of corporations. I mean, BP Ventures has been around, luckily, for a while. You've done, 5 funds, and there has been that continuity. But again, if you're looking at other CVC co-investors, if it's that, is this just the whim of the CEO changes next year? Who wants to commit to something that's a 15-year project to see some return? And I don't know how you solve that. How do you, what kind of pitch can kind of get you beyond that?
I think part of it too is, and I think when we're in corporates, and my experience was previously with financial VCs, and I didn't have to do this, but I think this is where it can be effective, is socializing the deal internally and getting feedback from other people so that you can get that buy-in. And I think that also then helps with your narrative when you're going to investment committee of why this is important, why this has the potential to transform. Because, I guess, and this is another kind of topic as well, but, as a CVC, having been on both sides, we offer a whole lot more value for our capital, and it's leveraging, the financial assets, the physical assets, and the human capital assets. And so I think actually to deliver on that promise, you do, especially for some of these kind of step out or harder, longer term investments, getting those people's buy-in, and maybe it's not then the CEOs, but it's a divisional head who this becomes a champion for, and then they're your advocate, and that gives you a bit more longevity. But you're effectively marketing to IC, but you have to kind of market to the organization too, I think, sometimes.
And is that sustainability conversation getting easier now? I mean, oil companies are just under, or energy companies of any sort are under huge pressure to kind of show that they're doing a lot in the sustainability field, and the oil crisis and so on is adding to that. But I just wonder whether can you capitalize on this moment and kind of get some of that through, but then get it embedded so that it can live on?
I mean, the sustainability piece is core for us. I mean, Bernard's tag, and I feel like, it is quite catchy kind of marketing, but it's performing while transforming. But we actually have to transform now, ventures, in order to perform in the future, because we're the engine for change. And most people in the business see that. And that's where I do think, as CVC, we've got a really cool job. We get to play in a really big sandbox with a lot of cool technology. But I think that sustainability, I mean, at least within BP, I mean, if we don't address, and I think what you're probably getting at is where oil prices are today, is, can we put the sustainability agenda to the side because actually we have the potential to make? Is that what you're?
Well, it's a combination of two things, right? One is that you have a lot of money, or at least are perceived to have a lot of money at the moment because of higher oil prices. I mean, to the point where, lots of governments are then talking about windfall taxes as a way to kind of, redistribute that. So if you're not seen to be doing quite a lot of other, beneficial for the world things right now, I think that conversation just gets louder about, because I think one of the things that a lot of energy companies are saying in their defense is like, okay, well, one of the reasons why you shouldn't impose a windfall tax on us is because then we won't be able to invest in all of these wonderful things that we're doing to kind of help the energy transition. So right now is a great time. It's absolutely urgent for any energy company to have a very visible, very visibly succeeding and extensive sustainability platform that they can talk about. And so that, at least that must be very clear to everybody in top-level management.
Yeah, I mean, as an investor, I think we all know, timing is everything. When I look back at my career and I, outsized some of the better returns, it was timing. Sometimes drove some of those. We rerode the market and did so to our advantage. And I think if I fast forward to the future, I think we will look back on this moment and hopefully reflect, that current energy prices enabled us to accelerate the transition. We've got excess capital, and I think recognition that time is not on our side. 2020 was the hottest year on record, and guess what? 2021 beat that, and 22 is set up to be the same. We've had wildfires from Australia to California. These things aren't changing. So I think there's a recognition that we have to act now, and a lot of governments are also saying energy security is political security. So we've got to advance the energy transition. The one challenge with that for all of us, at least I look at my portfolio companies, commodity prices are not moving in their favor. And so it is challenging.
But it strikes me that because of all of those reasons, these are projects that should be able to be then championed by a succession of people. It doesn't matter how often you reorganize, and the leadership changes and so on. I mean, these should be concerns for everybody coming along. So again, it should be a moment to be brave and make that long-term investment.
Yeah, I agree. And I think the other thing is if I take kind of our experience and I apply that to some of the other CVCs, I think, and your comment about, is this a pet project for a particular CEO or CFO, and if the strategy changes, corporates are large organizations and they're not like our startups where they pivot to reach a market. The strategy is pretty consistent. So our portfolio and our investment theses shouldn't we've gotten it wrong if they're fundamentally changing with a change in leadership. They're broadly fairly consistent.
And just to kind of bring the story to an end, so what's your plan for the startup looking for its funding round? Do you have how will you likely proceed?
I mean, what we've done is we've shifted and we've used our network and introduced a handful of CVCs in our network to the company, hopefully to help them raise the capital. And I mean, my colleague and I are quite passionate about this, trying to get this deal done. And the other thing we've said is, look, do we need to actually sit with the management team and kind of have a coming to Jesus moment and, have a face-to-face, because it's not working over Zooms and Teams. And I think we've also realized after 2 years, those things are hard. And I think start whiteboarding who might be a potential investor. And I think thinking a little bit outside of the box too. We haven't worked with pension funds before. We haven't worked with sovereign wealth funds, but these guys have a longer timetable like ourselves. So I think that's where we are at the moment. But
okay.
Yeah, hopefully I'll be back in 2 years saying it's done.
Yeah, well, watch this space. But I guess if you see a sustainable aviation deal coming through with BP leading, then we'll know that it's come good. So, but thank you very much, Erin. We'll look forward to part 2 of that. And I can smell lunch, so I think we probably really do have to finish there.
Thank you very much.
Thank you.